Hey guys, welcome back. I'm going to talk about StoneCo again. They released earnings maybe a month ago, and I have been too busy to do any of these videos. I'm way behind. I probably got to do 10, but I'll try and bang this one out quickly, get it out. Just as a quick reminder, though, this is not financial advice. These videos are mostly for me. I use them to check my thinking and sort of as accountability because I know that you guys are watching, and if I know people are watching, then I'm more accountable to what I say. But I got nothing to sell. I'm not trying to win YouTube or anything like so. If you get value from this, great. If not, sorry. But in this video, I'm going to talk about StoneCo and the results that came out a few weeks ago or a month ago. The market didn't like them, the way it crashed right after the earnings, and then they got downgraded a couple of times, maybe more actually. And I actually think that everybody's wrong. I think that these quarter two earnings were quite good, and the company looks actually really healthy to me. And so that's a pretty maybe arrogant statement. And if I turn out to be wrong here, I promise I'll admit it on the video. I do like it when people admit when they're wrong. I think it builds credibility. So I will definitely tell you guys if I think I'm wrong on this one, if I figure it out later and the market and everybody else is actually right. But for now, I'm sticking with my position that I'm right, everybody else is wrong. Joking, of course, there are some very strong hands out there holding StoneCo shares. So in this video, I'm going to go just quickly over the thesis I have with StoneCo and why I think it's still intact. I'll go over the quarter two items, and I think there were some hidden good items here that are masked by some things that don't actually matter. So I'll go over that, why I think the results are better than they first appear. I'll review my there's actually two catalysts I'm going to talk about this time. I think I only talked about one in the last video, but I think there's two pretty strong catalysts that are probable over the next 6 to 12 months. And then at the end of the video, I'll just do a quick valuation, update it a little bit. Yeah, so with that said, quickly on the thesis, basically this is one of the only companies that I've ever found that has been able to do over 30% growth and 30% net margins. So I call it a 30-30 club, and they're not in that club right now. They have over 30% growth, but the margins are down, I don't know, about 4.5% so far this year, and I do believe they're going to go back up to 30 or more percent, maybe at least 20, I think, over time. But I think 30 is still definitely possible. And the other part of the thesis is I think they're building an ecosystem moat here with their merchants. So basically they're trying to fulfill all the merchant needs and just package all these different bits of software and products and banking and everything that they can develop on the tech side. They're bundling it all together, and the idea there is that if one company owns all the pieces, all the bits of software that a merchant needs, they can make them work better together, and also they can end up undercutting the competition on price because, let's say you're getting software from 5 different, in your point of sale system, in your banking, you're getting all this from 5 different sources. Well, they all need to make a margin on that, and so you're probably not going to get any savings there. And also it's complicated to make them all work together. Whereas if StoneCo runs all of those products, they can have low margins on some to kind of build the moat, and they can, basically they can undercut on price, and it creates a high cost of switching to peel one of those items off and take it somewhere else. Okay, before we go into quarter two, just a quick note on the stock price action. If anybody's curious, we had a big drop right after earnings, and I think what that is I think that is just traders. I don't think that had a lot to do with the actual earnings. I think what happened was everybody who follows Stone knows that they lowball their guidance, and then there was going to be a big beat, and there was. And if you look at what's happened the last few quarters, is the stock runs up into earnings and a little bit after earnings. And I think traders were just getting ahead of that that movement, and then when the earnings came out, everybody sold. So it's like a buy the rumors, sell the news kind of situation. So that's my take on it. Maybe there's some stuff hidden here that's really bad that I can't find, but that's just my guess of what's going on here. So in quarter two, if we look at the growth numbers, I mean, everything was up a lot, basically. Like they're just in hyper growth mode, and it's just par for the course right now. Revenue's up almost 83%. If you take out the acquisition last year, it's 11.3 quarter on quarter. So it's slowing down, but that's still very fast growth. And maybe the slowdown in growth, maybe that's what people didn't like. They're like, oh no, it's only growing at 45% annualized. That's terrible. Maybe I don't know, maybe that's what's going on. But yeah, software is up, 23%, I think, and financial services up 102%. So that's the growth engine, is the financial services. We don't expect software going to grow fast. They've told us about this, but financial services looking great. Total payment volume up 50% for the year. It's 8% quarter on quarter. Number of clients way up again, 10% quarter on quarter, 100% year over year. Banking clients were up 55% and year over year, but not huge on the quarter. And I think this has to do with, because they still don't have their credit product up and running. I think that might reaccelerate when they get the credit going again. But the banking or the deposits on hand went up significantly, and I think that has to do with interest rates being very high in Brazil, and people just, the central bank's doing their job, right? They're getting the interest rate ahead of the inflation rate so that people choose to save their money instead of spend it, and that's what's supposed to happen. The deposits will go up over time if that's the case. Their take rate is up on the quarter again slightly, and in the transcript that I read, the CEO said that in August they actually increased it pretty significantly again. So that's going to be going up in quarter three, unless he's lying. I don't have any reason to think he's lying. So I think it's going up pretty to a pretty healthy level in the next report. What else? Okay, so if we go to guidance on revenue, they guided pretty low, and again, maybe this is what the market didn't like, but everybody knows that they lowball this stuff. So if we take it and put another, let's say 4% on top, which seems to be how much they beat by usually, you get to about 2.5 billion in revenue. And that would be an 8.7% growth rate quarter over quarter, and annualized that's 35%. So that's fast, but slowing down. So again, maybe this is the problem. Maybe people think it's going to go to zero. I don't think that, but perhaps that's the fear here. If we look at profit quickly, the earnings before tax was 107 million. That's 20% ahead of their 90 million guidance. So they crushed the guidance on that one. And they also had a write-off here for the Lynx acquisition, this is just a small one-off adjustment. And without that, it would have the pre-tax profit would have been 120 million. And if you compare that to last quarter at 78 million, that's more than 50% improvement quarter over quarter. So that is a very fast improving bottom line. So this is one of the things that I like. I think the profitability is starting to look a lot better, and it's improving pretty quickly. And if we look forward a little bit, just as a quick sort of guidepost to see maybe how this year lands, they have if they have maybe 300 million for the last 2 quarters, and that's reais, that's not US dollars, then that would put them about 500 million for the year. If you translate that to US dollars, that's about 100 million, depending on the exchange rate. And that puts us at, like a 25, 26 times pre-tax earnings multiple. So maybe maybe what the market's doing is they're pricing the company based on the current situation. Maybe it's priced fairly right now at 26 times pre-tax earnings. and that'd be over 30 times after-tax earnings, 35% growth rate going forward. And the market says, this is about right for that. But it's not. What it's not doing is taking into account these catalysts, which seem pretty likely, that I'll talk about shortly. And the last bit I'm going to talk about with the Q2 is the cost side. Now, I think this is one of the big wins, and I think this is hidden. Whoops, I've got to pull up my my screen here. Okay, so if we look at the costs here, we've got cost of services, admin expenses, selling expenses, financial expenses, and mark-to-market on equity securities. Now, if you look at the top three, those are kind of the ongoing expenses to run the business, right? Those are mostly personnel expenses. And if we pull out financial expenses, you can see this is a huge increase compared to last year. And then we have this mark-to-market expense. So let's do this one by one. So mark-to-market, that is their Banco Inter write-off. So actually, I think it was a poor acquisition. They kind of overpaid for Banco Inter shares. And this is basically just an adjustment to the current value of those shares. Now, it has nothing to do with the operating business here. It's just a paper write down to for those shares. Now, actually, the Banco Inter shares, I think, are up since then. So this might actually be a positive. But when I'm looking at companies, I never include this stuff. I think that the value of the investments held as they bounce around in the public markets, I think that's a ridiculous thing to count on the operating earnings. So I'm going to pull that out completely and just ignore that. And then if we look at financial expenses, now these are way up over last year, and that's directly related to the CDI rate, the central bank interest rate in Brazil. So what they do is they're going to borrow at this rate, and then they're going to use it to lend to well, it's not really lending. They're basically buying the receivables off their merchants at a discount. So they borrow, they pay this interest rate, then they buy the receivables, sort of like a factoring operation. And then they, book the discount that they that they charge the merchants as revenue. Now, what's happened over the last year is these interest rates have gone up through the roof in Brazil because inflation's through the roof there, and the central bank has just been hiking like crazy. And this is the first catalyst I see. So what's happening is inflation has started to peak, and it looks like it's starting to come down now, which means that the central bank is going to be able to, if it goes down, the central bank is actually going to be able to reduce interest rates in the economy. And if that happens, then this financial expense is, depending on how much it goes down, but this financial expense will come down as well. So I think this is not a real indication of how the business is going. I mean, they're borrowing at, I think, 13, like what's the CDI rate, 13% or something now. If that stayed like that, okay, that is a cost of doing business. But I think the reality of what's happening here is the whole world is trying to kill inflation, and it's going to work at some point. And inflation is going to come down, and all the central banks will be able to ease at some point to help their economies, because the inflation is going to hurt the economies. So, and especially in some place like Brazil, where they have a huge exporting part of the export is a huge part of the economy, a lot of natural resources. And if you look at any of the charts for any resources, they're all coming down. All the food products and energy and everything are coming down. So I would expect that, long story short, these financial expenses should come down at some point. Just got to keep an eye on the rate, on the CDI rates, and what the central bank is doing there. They've actually paused for now. They're not raising anymore. And the way these central banks operate, they operate in waves, right? So once they start raising, they usually keep raising. But when they stop, they probably will stay stopped for a while. And then if we see them come down, that will be the beginning of another wave that comes down. They don't do random hikes and cuts, month by month. They go in waves, and it's kind of telegraphed what they're doing. So they've recently stopped, and I think that's a big potential catalyst here if these rates come down. Now, one of the other things here that's hidden in the cost side is if you add up cost of services, admin expenses, and selling expenses, those are the consistent ongoing costs that the company is going to have to run their business. If you look at the last 5 quarters, these have not moved in 5 quarters. I think they actually came down last quarter compared to quarter 1 as a whole. Maybe that's not right. But basically, over time, the operating leverage has become enormous, right? So you have these fast-growing revenues, and these operating expenses are not really moving, right? So any growth is almost all going to the bottom line, all things equal in terms of the financial expenses and mark-to-market. So the operating leverage here looks enormous, and I think that is one of the things that people are missing here in this quarter, because if the growth continues, that's going to add to bottom line very fast, especially if the financial expenses don't go up. Okay, I missed one thing there. I'm going to talk about credit here, but one thing I missed in the expense side was that when Tiago was speaking, he said that somebody asked him about, well, what happens if the interest rates come down? Are you going to reduce your pricing? And he essentially said no, right? So they can keep these take rates high, he thinks, and the costs go down. So historically, the take rates have kind of moved with the interest rates and the cost side, but he's saying they're not expecting to bring it down. So that's actually the main thing in terms of the expanding margins there when interest rates go down. Now, he might change his mind if the competition, starts doing that, but the intention is definitely to keep the take rates high. Okay, and quickly on credit. So this is the second catalyst. It was actually the only one I talked about in the last video, so it was the first catalyst there. But for anybody who doesn't know, they had to shut down their credit product. They would basically have working capital loans for their merchants, and they had to pull it because there was a regulatory change, and they weren't protected enough against the change, and ended up taking huge losses on the amount of the loans that they'd sent out. Basically, what happened is the merchants pledged their receivables against these loans, but some of the merchants had pledged them against multiple loans, and basically Stone was left without any collateral, so they couldn't collect. So they stopped the program. They shut it down. They're in retool mode for the last year, and they've recently started to test this again. So they look like they're being a lot more careful this time. They're testing small scale right now, and the intention is to bring it back end of 2022 and early next year. So it's good that they're not sort of going full guns blazing like they did last time. It looks like they're being a lot more careful now. The CFO has just left, so I wonder if that has something to do with it. I mean, he would have had a hand in, the first plan. So maybe he was pushed out. I don't know. But somebody asked me about that at CFO, and I'm actually not worried about that. I actually think that it would be good if they got another CFO, because that Banco Inter purchase doesn't look great to me. Doesn't look like a good use of capital. It doesn't look like a good decision to sell at, buy high, sell low. That's kind of silly. They could have just kept it. But I digress. New CFO, they're more careful on the credit side. They've hired a head of credit, and they're in testing phases. And the other part of the thesis is that this is a high margin product. If it comes back and it does well and it grows to a big level, because this is the majority of their total addressable market. I think it's 80 billion total addressable market in credit versus 30 billion and everything else. So if this works, this is a huge catalyst, and this is the thing that I think is going to drive the margins back above 30%, if it works out and they get going on it. Now, they didn't give a really clear timeline, but it looks, my guess is that it'll be at a level that's material sort of sometime next year. And on the other side, though, there's a risk attached to this. I think that if you're a merchant, you probably want this product, right? So if Stone doesn't manage to get it going, then the competition starts to look better, right? If PagSeguro's got a fairly robust banking product, and that's one of their direct competitors, or you can go to Mercado Libre, who's a beast in this space. So it's a risk as well. I think they absolutely need this product, and if they didn't get it going, I would consider getting rid of this stock, because I think it's absolutely vital to the long-term thesis. Okay, and just in summary, basically I think that this was a good quarter. The growth is slower than it was before, but it's still fantastic. Margins were up significantly from quarter two. If you back out the mark-to-market expense caused by Banco Inter and the one-off write-offs from that Lynx acquisition, their pre-tax profit was up 50% from the last quarter. So definitely going in the right direction. And then the long-term margins should continue to increase based on one or more of these factors. So they have their higher take rate coming in this quarter. Maybe it keeps going higher, but even if it's just a one more increase, that's great. They're now at a healthy level for that. And then the CDI rates, the government interest rates, those are plateauing and potentially going to come down in the future, which would reduce the financial expense cost. Also, they have the operating leverage because their expenses to run the business are basically staying flat right now, and they're committed to keeping those under control. And then the other good thing that could happen is the credit restart could work out well. They could get that up and running. So there's a lot of paths to winning here. And I'm still really happy to own this company. I think that I'm not concerned by anything in this report. So if you think I'm wrong, let me know. Let me know what I'm missing and why you're worried, or if you agree. But yeah, I think that they, also just to add, they say they're going to get about 125 million in pre-tax profit this quarter. So again, they're probably lowballing that, might even get up to 150 million. And then that would lead us to at least, probably 500 million for the year of Reais profit, which is over 100 million US. This is a great company. I love the growth. I love the margin potential. And yeah, that's it for this video. Hopefully everything goes well, and we'll see you in the next video.